This is my first live stream. I'm still trying to figure out how this whole thing works. Um, Hopefully, when I get a bit better at this, it'll be a bit more of a smoother transition. I'm actually looking to share my screen because I've prepared a few slides. I see a couple of people are already online. So, for those of you who are here, thank you for joining. Like I mentioned, it's my first time. I want to start doing some more live streams and connecting with you on a different level. Live streams are nice because it's a way in which we can interact in a more natural manner. Today, I wanted to talk to you about inflation. I'm sure that if you're an investor and following my channel, you're probably interested in the property space, and you've seen the South African Reserve Bank increase the interest rate by 50 basis points. I'm here to tell you that it's not over. In fact, it's probably going to get a bit worse before it gets any better. Inflation is an interesting thing, right? Inflation is essentially the rate at which prices increase over a given period of time. If you think of the price of a cup of coffee, right? In the 1970s, a cup of coffee was 25 cents. I'm using dollar terms just to keep this conversation quite general. In the 1980s, it was 45 cents, so it had grown essentially double in price over 10 years. Now in 2022, your average price of a cup of coffee is $1.8 to $2, 1.8 or $1.5 to $2. It started off at 25 cents to now almost $2. That's a substantial amount of growth. And that's the thing about inflation. It's the rate at which things increase over a given period of time. Since the start of May 2021 to the end of May 2022, here are some of the increases in some of our daily products. If you look at eggs have gone up by 32% in the last year. Poultry, normal chicken products, 17%. Milk, 17%. Coffee, 15%. Baked goods, 11%. Going out for dinner, 9%. Fruits and veg, 8%. So, I mean, you can already see our cost of living, our cost of just living our current lifestyles has increased substantially, where most of our salaries, let's be honest, has not increased at the rate that we want it to. The latest estimates are hitting that the food inflation hit 10% in May 2022, which is one of the highest rates seen in the last decade. And there's a lot of things, a lot of reasons for this, mainly the war in Ukraine and Ukraine being such a big provider of foods and stuff like that. That's obviously caused a lot of grief. So because of COVID, we have to understand the reason why we're in this situation. COVID created such I would say, a really bad ground for us to stimulate the economy. Because when COVID hit, we lost our GDP, not just South Africa, but every country lost its ability to earn and to grow its economy. And obviously people working from home, so some lost their jobs, etc. So what the government had to do is they had to do two things to be able to stimulate the economy. Number one, they had to print lots of money. Now, as you print money, you essentially devalue that currency. So, it's maybe a short-term solution, but in the long term, every currency is going to inevitably end up at zero because of excessive printing of money. And then they lowered the interest rates. Now, lowering the interest rates is a very important element of stimulating the economy. Okay, so let's understand what an economy is, right? The economy is the sum of all transactions made in a society. So someone's spending becomes someone else's income. Spending drives the economy. So if you let's think of the car market, right? You've got a whole bunch of cars. The more people are buying cars, the bigger that car economy grows. In South Africa, we've got a very strong car economy. We buy cars, I buy cars, you buy cars, all of these different car companies. And there's constant transactions in and out, which is great because that stimulates that market and it grows that market. And that then ultimately grows our economy and our GDP as a country. That then stimulates job growth, etc. It also stimulates taxes. That stimulates our SARS collection rate. We get better services. So economic growth is really good. If you think of the property market, again, when more people are buying property, the property market grows, our economy grows. So when COVID hit and we had all of these tight economic conditions, people were panicking. What the Reserve Bank did. Now, every country has a different reserve bank. In South Africa, it's the South African Reserve Bank. In the US, it's the Federal Reserve. They've got the ability to control monetary policy, which basically means that they can control how much money is in and out of the economy. Now, when COVID hit, that is when we saw these severe reductions in interest rates, because the Reserve Bank said if we can lower the interest rates, it'll be more attractive for people to want to use money, to use credit, to leverage capital from the banks, and they will then go and buy cars, they'll go and buy property, they'll go and buy and stimulate the economy, because the economy grows with stimulation, with spending. So in tough economic times, what the Reserve Bank does is they lower interest rates to entice people to lend so that they can spend, thus grow the economy. But then they also have to fight this other thing called inflation. If you just throw money, if you just make interest rates super low and everybody starts to buy, what ends up happening is your goods and services start to grow. The cost for purchasing these goods and services grow. And eventually, your cup of coffee is now worth $20 or $100 is to buy a cup of coffee. So you have to find a balance. And that's what the Reserve Bank is here to do. They have to find a balance between stimulating the economy with attractive interest rates so that people want to grow and that the economy grows, but also not letting inflation run too high. So the South African Reserve Bank, or the Reserve Bank within any country, it controls the monetary policy. They then loan money to the commercial banking industry. In South Africa, we've got our main commercial banks being the Standard Bank, Absa, FNB, Nedbank, etc. So the Reserve Bank will essentially lend money or provide liquidity to these major banks at a rate called the repo rate. Now, the repo rate is the rate at which the Reserve Bank lends money to commercial banks. Currently, that's sitting at about 4.5%. Then once the banks have that liquidity, they then sell that liquidity onto either an institutional investor like a Growth Point or some sort of company that invests in property, or to people like you and I, individual investors. And that's where we get a prime lending rate, which is the rate essentially that the banks provide South Africans or institutional investors with. Currently, prime is sitting at about 8.25. It's already gone up a couple times. There's already been 2 or 3 increases. I'm here to tell you it's going to get worse. It's going to get worse before it gets better, because in order to fight inflation, right, the South African Reserve Bank has to do the opposite of what they were doing to stimulate the economy when COVID hit. They have to increase interest rates. So while inflation is high, and there's certain numbers that the Reserve Bank works within, I don't know what those are exactly. I think it's sort of 4 to 6% is the healthy range of what inflation should be, sitting at 10%. So what they have to do now is they have to tighten economic conditions to be able to reduce inflation and be able to find that balance between growth as well as keeping inflation in check. So what does this mean for us as property investors? I think there's going to be a lot of distressed sellers coming into the market. A lot of people that didn't budget for such increases in their prime lending rate. Whenever I ran my numbers, if you've seen any of my other content, I always use a prime lending rate of 10 or 9%, because I knew that COVID was a temporary situation, and the economic relief that we got from the Reserve Bank during that tough time was temporary, because what they wanted to do was stimulate the economy with attractive interest rates to a point where the economy recovered. And now that COVID is kind of, a bit of a memory, and things have gotten back to normal, now they have to curb this counterbalance, which is inflation. And this is not just the property market. We've seen it within the stock market. If you invest in the stock market, you'll also have seen the S&P 500, NASDAQ, the Dow Jones. They were all sitting in incredible returns over the last 3 years. The S&P 500, the last 3 years, that's 2019, 20, and 21, it had a 28, 16, and 26% annual return, which is phenomenal. The NASDAQ over that same period, 35, 43, and 21, and then the Dow Jones, 22, 7, and 18% respectively. So you can see the 3 years that COVID had, the stock market represented what a great economic time it was, because there was such cheap money that was being either printed by the Reserve Bank or through the use of a attractive interest rate. So we went through a bull market, right? That's pretty much what we've been going through the last couple of years. But now inflation is sitting at that 8.5, 9%. It's raging out of control. So the only thing the reserve banks have left to do is to be able to tighten economic conditions. And that's why we've seen the stock market crash essentially over the last couple of months. The S&P 500 is sitting at roughly minus 17, 18% when I last checked. The NASDAQ was sitting at minus 25%. The Dow Jones at minus 16% for the year. So all of these three funds, these index funds that had done between 15 and 30% over the last 3 years are now in massive amounts of red. The last 5-6 months has really been a bloodbath from a stock perspective. And I think property is next. I don't want to be a bearer of gloom and doom. I think if you've run your numbers using a higher interest rate and you've made sure that your rent and your yield is substantial to be able to absorb that interest rate, I think it's going to be a very good time to be an investor, because there's going to be a lot of people that haven't planned their money very well. They're going to be distressed sellers selling their properties because they can't afford their bond repayments anymore. So if you've got a bit of cash saved up and you've got the appetite to get involved right now, it's a really good time to be an investor. So sorry for the kind of ramble. I wasn't able to share my slides, unfortunately, so I kind of just spoke through them. But this was my first ever live stream. If you have any questions, please pop it in the chat on the right-hand side. I'm happy to answer questions if there are any. Also, if there's any recommendations, if you'd like me to do a stream on a specific topic, then now is the time. Otherwise, get prepared. Good time to be an investor, but bad time to be an uneducated investor. You know what they say, and I think, if there's no questions, I'll probably leave on this comment, that more millionaires are made in a recession than in any other time. So if you're able to save your money during the tough times, you can really make a lot of money. So save during the good times to invest in the bad times. Buying the dip, that's my strategy right now. Is I've decided to put a little bit of money into buying the stock market, because I believe that there's just huge opportunity there. And the property market, I've been invested for 10 years. I'm not going to stop now. I'm going to keep going. Cool. Well, I don't see any questions. Thanks for you that did join. Again, if you have any topics or comments of things you'd like me to talk about in future, I'd love to hear from it. Otherwise, enjoy the rest of your Monday evening. Until next time, happy investing.